As of Wednesday, December 24, 2025 at 10:45 a.m. EST, Intel stock is trading at exactly $35.50 USD, marking an intraday decline of 85 cents or 2.33%. While the broader indices are showing holiday season resilience, Intel is facing a sharp, localized chill that most retail investors didn't see coming. The immediate expectation was that Intel would glide into the new year on the wings of its 18A process node successes, but the reality hitting the tape right now is far more complicated. In a move that has sent shockwaves through the semiconductor sector, reports have surfaced this morning that NVIDIA has officially opted out of using Intel's 18A process for its next-generation chip production. This isn't just a minor setback, it's a fundamental challenge to the core narrative that Intel was finally ready to play in the same league as TSMC. When you look at your individual brokerage or check your positions on the Robinhood app, you're seeing a price action that reflects a sudden loss of confidence. The market had priced in a world where Intel Foundry was the inevitable second source for the giants of Silicon Valley. Instead, we are seeing the Foundry of the West struggle to keep the biggest fish on the hook. The gap between expectation and reality is widening. Most people looking at Intel stock over the last few months saw a company that was successfully pivoting. They saw the $5 billion deal with NVIDIA earlier this year and thought the path to 2026 was paved with gold. But if you look deeper into the institutional activity on the Interactive Brokers platform, you'll notice a distinct shift. Big money isn't just reacting to the NVIDIA news, they are reacting to the underlying reason. It turns out that while Intel's Fab 52 is churning out 40,000 wafers a month, the yields, the actual number of usable chips per wafer, are significantly lower than what TSMC is delivering. This is the reality check the market is struggling with today. You can have the biggest factory in Arizona, but if the output isn't efficient, the costs will eat you alive. This is exactly why specialized tools like Schwab Intelligent Portfolios or a sophisticated SoFi robo-advisor might be rebalancing away from heavy concentration in Intel today. The smart friend take here is that Intel isn't just fighting a technology war, it's fighting a chemistry and physics war, where good enough doesn't cut it when your customers are paying billions for perfection. If you're checking your Fidelity investments or scrolling through your Robinhood investments today, you might be wondering if this is a temporary dip or a structural crack. Let's look at the trading volume. We're seeing nearly double the average relative volume for a midweek holiday session. This indicates that institutional players are actively repositioning. They aren't just sitting on their hands. When NVIDIA, a company that represents the pinnacle of current compute demand, decides that your manufacturing isn't quite ready for prime time, it casts a long shadow over other potential clients like Apple or Qualcomm. Many investors using online investing platforms have been taught to buy the dip on national champions, but with Intel, the dip is often a reflection of a multi-year execution lag. The common ground here is that everyone knows Intel is too big to fail for the U.S. government, especially with the 10% equity stake the government took earlier this year. However, being too big to fail doesn't mean the stock is a too good to pass up investment at $35.50. The tension in the market right now is palpable. On one hand, you have the Panther Lake launch approaching in the second half of 2026, which Intel claims will be the definitive proof of their 18A superiority. On the other hand, the reality of NVIDIA walking away from 18A suggests that the expectation of a seamless transition is a fantasy. For those of you managing your own self-investing strategy, this is the moment where you have to decide if you believe the CEO's roadmap or the actions of Intel's potential customers. If you look at the Fidelity trading platform, you'll see that the bid-ask spread is widening, showing a lack of consensus on what this company is actually worth if it can't secure external foundry clients. Without those external clients, Intel is just an integrated device manufacturer with too much overhead and not enough market share. Comment below how many shares of Intel stock you currently hold, and if you think the 18A node will actually be a success by 2026, or if it's just more talk from a company that's lost its way. To understand why 3550 is such a precarious level, we have to talk about what Intel actually does versus what people think it does. Most of the public still sees Intel as the Intel Inside company, the people who make the chips in your laptop. And while that's still a massive part of their business through the client computing group, the real value of the stock in 2025 is tied to Intel Foundry. This is the part of the business where they build chips for other people. It's a high-stakes, capital-intensive business that requires billions in gross capital expenditures. Earlier this year, Intel reported that they were on track to hit $17 billion in operating expense targets for 2025, but those targets were set with the assumption that external revenue would start flowing in from the likes of Nvidia and Broadcom. When that revenue gets delayed or canceled, the math breaks. If you're using Fidelity Wealth Management or a similar service, your advisor is likely looking at Intel's declining margins with a very critical eye. A 27.5% gross margin is a far cry from the 50 or 60% levels Intel enjoyed in its prime. Let's talk about the competition for a second, because Intel doesn't exist in a vacuum. While Intel is down 2.33% today, its rivals are often the beneficiaries of its struggles. For those of you tracking Nvidia stock or Apple stock on your Fidelity mobile app, you're seeing companies that have mastered the art of outsourcing. They don't want the headache of running a factory, they just want the best chips. By passing on Intel's 18A, Nvidia is essentially saying that TSMC is still the king. This keeps the competitive pressure on Intel at an all-time high. Even more concerning is the progress of AMD. While Intel has been focused on its foundry pivot, AMD has been relentlessly taking market share in the data center space. If you're doing your online investment research on sites like SoFi Invest or using interactive brokers trading tools, you'll see that the sentiment for AMD is currently much higher because their story is simpler. They design great chips and let TSMC handle the manufacturing. Intel is trying to do both, and right now it looks like they are struggling to do either at a world-class level. The historical context here is important. Intel has spent the last 5 years trying to fix the mistakes of the previous decade. They missed the mobile shift, they fell behind on 7 nanometer, and they let the foundry model become the industry standard without being a part of it. The current 18A and 14A roadmap is their all-in bet. If they win, the stock at 3550 looks like the deal of a lifetime. If they lose, it becomes a value trap that could languish for another 5 years. This is the reality that long-term holders in Fidelity IRAs have to contend with. The company is literally rebuilding itself while the plane is in the air. We've seen them install ASML's most advanced high-NA EUV machines recently, which is a huge technical milestone, but a machine is only as good as the team running it. The fact that TSMC is already installing similar equipment in their Arizona plant, which is just 50 miles from Intel's Fab 52, means Intel doesn't even have a home field advantage anymore. Looking at the intraday movement again, the volume at the 3550 level suggests a lot of forced selling. This often happens when a stock hits certain technical triggers or when Robinhood fractional shares are liquidated as part of broader portfolio rebalancing. If Intel breaks below the $34 support level, things could get very ugly very fast. The next few weeks are critical. We need to see if Intel can announce a new high-profile partner to offset the Nvidia news. If they don't, the narrative will shift from Intel is the comeback story of the decade to Intel is a legacy company that can't compete in the AI age. For those of you using investing sites to find the next big thing, the intelligent portfolio move is often to wait for the dust to settle. There is no prize for being the first person to buy a falling knife, especially when that knife is a $170 billion semiconductor giant. The business model of Intel is currently a hybrid that the market doesn't know how to price. On one side, you have the product business, CPUs for laptops and servers. This part of the business is still profitable, but facing intense pressure from ARM-based chips and AMD. On the other side, you have the Foundry business, which is a massive sink for cash right now. The hope was that by 2026, the Foundry business would start to stand on its own 2 feet, but as we saw today with the NVIDIA news, the timeline for that reality is being pushed back. When you use your SoFi trading platform or check your Interactive Brokers account, you're looking at a company that is essentially 2 different businesses with 2 different sets of risks. The product side is a stable legacy play, while the Foundry side is a high-risk startup backed by the U.S. government. In the final analysis, today's